Hey there, everybody. Welcome to another episode of SRT Live with me, your host, Sean, with the Sean Richard Mortgage Team. What does the Fed have to do to please the markets? And how will their economic policy impact our housing market? That's what we're going to be talking about today. Oh, my chair's sinking on me. There we go. Welcome. I am your host again, Sean, with the Sean Richard Mortgage Team here at Guaranteed Rate, and we've got a lot to cover today. We've got, there we go, right here at the bottom of the screen, we've got the Fed meeting. We're going to hear from Jerome Powell, affectionately known as J. Powell. We've got the NAHB Housing Index, as well as initial or weekly jobless claims. We're going to be talking all about all of that today. So let's start with last week. So if you saw me come on live yesterday talking about the blockbuster numbers that we got in CPI, Consumer Price Index. This is an inflationary report that measures inflation at the consumer level. It measures the cost of goods in a basket of goods. So I'll explain this again. Let's say you go to the grocery store and you buy the same 25 items every single month. Every single month you buy the same 25 items. Well, over time, you're going to be able to gauge or see the shift in cost, right? That 25 items may, if that basket of goods goes up and up and up over time, obviously you're seeing inflation. And so that's what CPI measures, the inflation at the consumer level on a basket of goods. Now, it's not the Fed's favorite measure of inflation. They like PCE, which is personal consumption expenditure. The big difference between the two is PCE does not take into consideration housing and rents. So it doesn't take into consideration the large expense that most households have. But the Fed tends to like that one a little bit better. So we got CPI last Friday, blockbuster numbers. Month over month inflation came in at 1% versus the anticipated 0.7%. And year over year inflation came in at 8.6%, which was above the expectation of 8.2%. That 8.6% was the highest level, you see there on the screen, since December of 1981. So to say that we are in a high inflation environment is a little bit of an understatement. Now, you're seeing it at the grocery store, you're seeing it at the pump, you're seeing it across the board. So you don't need me to beat it into you. But we are in a high inflation environment. But I'm going to talk about when we might see some relief here in just a bit. So stay tuned. So we got CPI last week. As usual, we also got jobless claims, both initial jobless claims as well as continuing jobless claims. As a reminder, jobless claims or unemployment claims. Initial is people filing for unemployment for the first time, whereas continuing claims are people renewing their unemployment claims. So month over month, we got on initial claims, week over week, we saw initial claims rise from the prior reading of 202,000 to a reading of 229,000. And if you've heard me talk about this before, unemployment claims ticking up after a bottoming out could be a recessionary indicator. Now, I think we've all heard the news articles, the news media talking about, oh, we're heading to a recession. You've heard me talking about that for a long time now, and everybody is catching on. So this is just one more potential indicator that we could be heading into recession. And I don't tell you this to promote fear or to worry you about a recession. My goal is to educate you so that way we can plan, prepare, and weather a recession and come out on the other side looking even better. And I keep my chair, I'm gonna have to replace this chair. This chair is very problematic. Gonna have to get this replaced. We also got continuing claims, which was actually right in line with the previous reading. Previous reading was 1.306 million, and then we got 1.306 million again. So continuing claims still on par, but we had about a 20,000, 25,000 tick up in new claims. So again, we want to keep an eye on that. If that continues to rise, then we could see that yet be another signal that we're heading into a recession. All right, so let's talk about today and the data we got today. So last week we got CPI, Consumer Price Index. This week we got PPI, Producer Price Index, and this is inflation at the wholesale level. Now, inflation at the wholesale level isn't necessarily going to be exactly on par with inflation at the consumer level. Producers or wholesale don't have to pass all of those costs onto the consumer. They may choose to take other cost-cutting strategies to not have to pass all of that on to the consumer. So PPI, Producer Price Index, month over month, we saw an 0.8% increase, which was right in line with expectations. And year over year, we saw a 10.8% increase, which was actually a tick below what the expectation was from analysts. And that expectation was 10.9%. So we saw a tick below. Now, not a big enough margin to make a dent in where we're headed in inflation. Inflation, even at 10.8 versus 10.9 at the producer level, still very, very high inflationary levels. But as always, these are numbers that we want to watch and get an idea of the trend, the direction that they're heading. Obviously, lately, all of the above have been heading in the upward direction. And so one of the questions that I'll attempt to answer today is when we could see some relief from the inflation that we've got right now. All right, so this is a big, big week. Looking ahead, we have the Fed in their normal meeting today and tomorrow, and we are going to get the Fed rate decision tomorrow. And this is a decision on what they're going to do with the Fed funds rate. The Fed funds rate, as a reminder, is the short-term overnight lending rate. The last Fed meeting, they increased the Fed funds rate by 50 basis points or 0.5%. Up until yesterday, the expectation was that the Fed was going to increase the Fed funds rate by another 50%. However, we saw a Wall Street Journal article come out yesterday hinting that we could see a 0.75% increase in the Fed funds rate. And I'm going to talk more about that in a moment. So we got the Fed meeting today, tomorrow. We're going to hear from Jerome Powell tomorrow as well. We want to pay close attention to his comments to see exactly what the Fed is planning to do about inflation heading forward. Also tomorrow, we get the NAHB Housing Market Index. That's the National Association of Home Builders. Builder confidence, essentially, is what that is. And then we also, on Thursday, get our typical weekly jobless claims, unemployment claims. We get housing starts and we get building permits. And those are a great indicator of where our new build inventory is headed in the future. So we want to pay close attention to those as well. All right, so what are we looking to watch going forward? I've got a laundry list today, and I'm going to try and get through it as quickly as possible for you so you can get on with your day and take care of your clients. First and foremost, we're watching the Fed rate decision. As I mentioned, we saw the Wall Street Journal article, and I'll put that in the comments below afterwards. So we saw the Wall Street Journal article hinting at a 0.75% or a 75 basis point increase from the Fed. There's some rumors out there that the Fed purposely leaked that information to prepare the market for a 75 basis point increase. So it'll be very interesting to see what they elect to do tomorrow. The inflation has been, on a tear, and one of the ways that the Fed can utilize monetary policy to combat inflation is to increase the Fed funds rate. Essentially, what that does is it dampens demand. So that way, if demand shrinks, supply remains stable, then we should see inflation come down. And so that is the purpose behind increasing that Fed funds rate. So how will the market react to this change tomorrow? That's going to depend on whether the Fed increases 50 basis points, 75 basis points, or possibly even 100 basis points. So it's going to be really interesting to see how the market reacts. My personal opinion is that the market is now expecting a 75 basis point increase. And if we get that, I think the market is going to be happy about that. And we're going to see a rebound in the mortgage bond market, which will help interest rates. And I think the stock market may like that as well, since that's what they're anticipating at this point. I think a 50 basis point increase could be cause for concern. It could be head in the sand syndrome. The Fed is saying we're going to put the blinders on. We don't care about what's going on around us, and we're going to stick to the plan that we had. And I think that could be a little bit foolish on the Fed's part, because the market's going to look at that and say, hey, the Fed is just, putting their head down and not paying attention to everything that's going on in the market. It could be problematic if they only do a 50 basis point increase at this point. But we'll wait to see how the market digests that. So that's kind of the story that we want to see unfold, that's the story we're going to see unfold based on what the Fed does tomorrow. Man, I am loving this chair super much. It's killing me today. All right. So what do future Fed meetings have in store? The original plan was a 50 basis point increase this meeting. The Fed meets again next month, and the anticipation is a 50 basis point increase, and then the Fed meets again in September, and that's starting to look like a 50 basis point increase as well. But data on a monthly basis will obviously influence their decision, and it'll be interesting. I don't want to say fun, but it'll be interesting to watch what the Fed decides to do in future meetings. Now, inflation, we're watching inflation as well. Shanghai coming out of lockdown is going to be important inflationary data as well. You've heard me talk about this before. As Shanghai comes out of lockdown, their energy consumption is going to spike, and that's going to put a significantly higher demand on energy, which could lead to energy inflation, which is contributing to overall inflation. So we want to watch what happens with inflation over the summer months as we see Shanghai come out of lockdown, and what impact the Fed increasing the Fed funds rate will have on inflation. It's going to take time for that to take effect. And the million-dollar question is how soon will the Fed increasing the Fed funds rate take effect on inflation? So million-dollar question, when will we see relief in the market? My personal opinion is I think in late Q3 and into Q4, we're going to see some relief. I think that's when we're going to see the Fed funds rate increases start to take hold, and we're going to see inflation start to dip, maybe September, October, November. And as inflation dips, we're going to see mortgage rates start to come down a little bit as well. And I think we could see further reductions heading into the middle to late of next year. So everyone that's buying a home right now is going to have some relief next year, where we'll be able to come back around, refinance them into a better position for their finances going forward. All right, 2023, again, I think could be a great refinance year. Home price direction. So what does that mean for home prices, people looking to buy? So my thought is that we're going to continue to see home prices rise. We're still going to continue to have a supply-demand dynamic that caters towards increasing prices. Demand is going to stay robust, even though that we've got buyer fatigue in some cases. We have some buyers that are unfortunately being priced out of the market, but we're still seeing robust demand. And a lot of that comes from homeowners that have a lot of equity in their current home that are able to sell and parlay that equity into a larger purchase. So I think demand is going to stay relatively robust. From a supply standpoint, we're seeing a little bit of a soft spot in the market right now, which is what we see every year about this time. We see inventory tick up a little bit because everyone who's been waiting for their kids to get out of school before they list their home, this is about the time that we're seeing that. So we've got a temporary soft spot in the market, and I think we're going to continue to see inventory stay relatively low, especially if we see interest rates rise over the course of the summer months, because those homeowners that aren't necessarily wanting to go from a 2.75 rate to a 6 or 6.5% rate may decide that they're going to hold off on buying. And that's going to keep supply a little bit low as well. That being said, I think it's still a phenomenal time to buy. I think those homeowners that have the equity can leverage that to go get into that home that they really want to get into, and without having to come out with a ton of extra money out of pocket. The appreciation is going to stay robust if we see this supply and demand dynamic stay in a similar position. And so those who are buying homes right now are going to see fantastic appreciation in the years to come. And then those who go out on that leap are also going to have the ability, if and when we do see rates come down, to go ahead and refinance the lower rates and lower their overall cost. So they'll get the benefit of the appreciation in the meantime, in the interim, and then get the longer term benefit of even lower rate environment. So still a phenomenal time to buy. I make sure that you're having these conversations with your buyers. If you're not already, feel free to share any information that I provide, content, so that way you can help them make educated decisions and not rely on news media who are really just out there fear mongering. So that is what we have to look forward to going forward, what we want to keep an eye on. If you have any other questions or you just want to talk about the market or how my team can help you do more for your clients, don't hesitate to comment below. Reach out to me at the number right here. Happy to have a conversation and schedule a call. Until next time, I want to say thank you so much for joining me on SRT Live. I am Sean with the Sean Richard Mortgage team here at Guaranteed Rate. Have an incredible week, and I'll be back next week with your next market update. Take care.